I've helped businesses raise over $100 million with this one forecasting method. This is the one cheat code I use to see if a business is going to make money. Let's talk about something super important if you want to start a business. It's called a financial forecast. That just means you're projecting how much money you'll make and save in the future. It's like looking into a crystal ball for your business wallet. Most people think this is just a bunch of boring numbers and spreadsheets, but guess what? I've seen it make business owners super excited or even super scared because it shows what's really going to happen with their business, their money, and their life. Today I'll show you the 5 parts of a business forecast that every company needs. These are the tools that will help you see the future of your business's money. This isn't legal advice, so always contact your lawyer or accountant. But when you're starting with financial forecasts, you want to start with 2 main statements. 1, your capital requirements chart, and 2, your income statement. The capital requirements chart. So if you're seeking a loan, you'll need to have this completed before you complete your income statement. The reason being, you need to understand how much interest you're paying and what the term is of the loan so that you can pay the proper amount of interest in your income statement. Basically, your capital requirements chart outlines all the items you need to pay for before securing a loan. Lenders will want to know how much money you need and what you need it for. This might include equipment, inventory, land purchases, or even working capital for the first year of your business. Next, let's get on to the income statement. Your income statement, also known as a profit loss statement, is something that is very linear. When you're forecasting, it looks out and projects your revenue, your cost of goods sold, your gross profit, operating expenses, EBITDA, depreciation, interest, and net income. The net income is what you get to take home, maybe. When you're developing an income statement, always set it up monthly so you can forecast the first 12 months of your business. This way, you can incorporate seasonality, units sold, and really get granular on the first year of business in terms of revenue. So once you have your revenue set up in your income statement, you want to look at cost of goods sold. Your cost of goods sold are the direct costs of running your business. So for a company that sells physical products, they would have to incorporate all of the materials, all of the labor, everything direct that goes into that product. For a consulting business, this might look more like the direct fees of your consultants or your lawyers for a law firm to provide your service. Administrative staff or management would not be incorporated here. Once your core costs are defined, you want to look at your gross profit. Gross profit is essentially your revenue minus your cost of goods sold, which comes to your gross profit margin and number. Now, operational expenses. These are the costs that aren't core to your business, but you still have to pay for. It'll be things like accounting fees, legal fees, rent for your office, a contingency, phone bills, marketing, pretty much everything outside of your core costs. Now we've made it to your EBITDA. EBITDA stands for earnings before interest, tax, depreciation, amortization. You want to take your gross profit and minus your operating expenses, which will bring you to EBITDA. Venture capitalists, private equity firms, they love saying EBITDA. Here's why. Your EBITDA is something that can be controlled. For example, you can pay off your loans, which would then increase the next thing, which is your net profit. The higher your costs are in terms of depreciation, interest, taxes, the reality is that will just shrink your net income even more. Private equity firms get really excited about high EBITDA because they know they control paying off loans, paying off debt, and really leaving more meat on the bone for your net income. All right, now we're at net income. It's your EBITDA minus depreciation, taxes, interest, what's left over. Now let's shift to your cash flow statement. A lot of people get caught up on the cash flow statement, but today I'm going to try to make it really easy for you. So your capital requirements must be developed first and your income statement. Then your cash flow can come in. If your net profit in the income statement was positive, that means you're going to have positive cash coming into your cash flow statement. If you're losing money in net income, that means that a negative balance will be coming out of your cash flow. So if you're developing these financial forecasts for an existing business, the first place you want to start in the cash flow statement is in terms of how much cash the company has on hand. So just imagine at the top, there's a balance of $10,000. If you're developing financials for a brand new business, start your cash at $0. From whatever that starting point is, you want to incorporate things like net income, which could be negative or positive, your dividends, which if you're paying them will be a negative sum coming out of the business, paying to shareholders, taxes paid, and also if you're investing into anything like equipment, that as well. And also if you're applying for a loan, the positive sum of the loan coming in and then the money coming out to purchase things like equipment or inventory, that would also be shown. Everything in cash flow is either a positive balance or a negative balance. So if you started at $0 and you had a $100,000 loan coming in, and then you purchased an $80,000 piece of equipment, you'd have $20,000 left over. Next, let's dive into your balance sheet. You have your capital requirements, income statement, cash flow completed. Now it's time to look at your assets, liabilities, and equity. One of the most important things to know about a balance sheet is that it must balance. The question is, do your assets equal your liabilities plus equity? Because they should. Let's start with assets at the top of the balance sheet. Your assets are broken into two different segments: non-current and current assets. Your non-current assets include things like equipment, machinery, and plant. These are things that are long-term assets that your company holds, and often they depreciate over time. Current assets include things like cash, accounts receivable, things that are in the short term. Okay, so now you have your assets established. Let's take a look at your liabilities. Just like your assets, your liabilities are broken into current and non-current liabilities. Your current liabilities are things that you need to pay very soon. Things like accounts payable, things like taxes payable. These are things that you should be paying within a year maximum. Your non-current liabilities include things that you're paying over a period of time, or for big businesses, things like pensions payable. These totals add up, and then you have your total liabilities. Let's take a look at equity. Your equity should include things like retained earnings. Retained earnings is your net income plus dividends paid. So if in the first year you ran a loss of $50,000, you would have a $50,000 negative retained earnings. If in your second year your business had $100,000 in net profit and you didn't pay out any dividends, then you'd have $50,000 in positive retained earnings. If you're ever going to sell your business, it's very good to have positive retained earnings. It shows strong financial health of your business. Additionally, in your equity, things like share capital will be involved. Usually when you start a business, you put a minimum of $10 to $50 into your company for shares. If you received an investment at any point in time, let's say of $1 million, that balance would also be in your shareholder equity and carried over time. Just remember that your assets should always equal your liabilities plus your equity. So if you're starting a business and you don't know if it's going to make money or not, it's okay. Just financial forecast. Use these 5 parts to see if your business will make money or if it will be in a loss. If you want help in developing your financial statements, reach out to our team of global, highly experienced business consultants.